This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Today, we are breaking down Cintas Corporation. The company's origins trace back to the Depression of the 1920s, when the company's founder, Richard Farmer, who at the time was a circus worker, began a small business to reclaim and clean rags for local factories in Cincinnati, Ohio. Nearly 100 years later, Cintas today is set to approach $10 billion in sales at a 10% 5-year CAGR and a 20% operating margin, putting it solidly in the high-quality bucket and trading at a multiple that's indicative of it. It is America's largest uniform rental company. For around $1.50 per worker per day, Cintas will collect, clean, and replace uniforms for organizations in industries such as lodging, hospitality, entertainment, manufacturing, healthcare, and with its business even extending to semiconductor fab bunny suits. It remains a family-owned business with multiple generations of the Farmer family having held leadership roles at the company, including CEO and today, the executive chair. To help break down Cintas, I am joined by Delian Entchev, a portfolio manager at Aoris Investment Management. We hope you enjoy this conversation. Delian, thank you for joining us to break down Cintas. It's a business that I think our audience is probably at least generically familiar with. Everyone sees the trucks on occasions. Perhaps a number of people appreciate the uniform rental side of their business. But I think it's probably lost on people that this is a 100-year-old plus family-owned and backed business with a rich history. Perhaps you can kind of give us the backstory of the business itself, size and scale, and hit us with the highlights, and then we'll go deeper on each of those points.
Let me start with what Cintas does, who its customers are, and then I might jump into the financial overview of the business and its history. Cintas provides essential route-based services to other businesses. What I mean by route-based is that Cintas has 21,000 delivery vans, and they have drivers going around to different customer sites and providing the service. These are essential business services. They're not core to the company's operations. So, for example, a hotel business, it's there to provide good hospitality services to its clients. But there's a lot of work behind the scenes, operational services, that are involved in the day-to-day running of a hotel, which can be outsourced to third-party providers like Cintas. So it's best known for its uniform rental services, which represent about 40% of revenue today. And what that means is businesses whose employees wear uniforms, that can include hotels, as I mentioned, can include hospitals where doctors and nurses wear scrubs, can include mechanics where they wear overalls. The business has the choice of either purchasing the uniform directly and getting the employee to launder it themselves. That involves an upfront capital commitment of maybe $500-$600 per employee. There's ongoing costs. The business has to be responsible for repairing and replacing any uniforms. The employee has to make sure they're getting the uniforms cleaned up properly. Or they can rent it from Cintas for about $1.50, $2 per day per employee, and Cintas takes care of the whole proposition for them. They don't have to carry any inventory. There's no upfront investment, just a low ongoing charge. And the benefit to the customer is, firstly, they can just focus on running their business. We're in the hotel business, not the uniform business or the laundry business. Secondly, it ensures that their employees are presentable to a high standard. Cintas will make sure the uniforms are always crisp and clean. And thirdly, for employees where the uniforms have a technical purpose, Scrubs in a hospital have to be sanitized to a high standard. Overalls worn by a mechanic have to be thick cotton so they don't get burned on the job. And one that might surprise you is one of Cintas's customers is Intel. So in Intel's semi-fabs in their factories, they have to be held to unrealistically high standards of cleanliness. Even a speck of dust can compromise the quality of a semi-wafer. So Cintas provides these lint-free, debris-free astronaut suits that Intel's employees wear in the semi-fabs. And finally, it can deliver this service at a much lower cost than what the customer could do themselves. For customers that do uniforms directly, it costs them about 2 to 3 times as much as what Cintas charges, because Cintas benefits from scale. It can negotiate with fabric suppliers and chemical suppliers to procure these supplies at a lower cost than any individual customer. And secondly, it's a uniform specialist, whereas this isn't the core competency for its customers.
And how big is Cintas's share of the uniform rental market? You mentioned the business is about 40% of revenue. What does the rest of the business look like?
So Cintas today has about a 40% share of that outsourced uniform rental market in North America. And currently about half of the businesses in North America that use uniforms still run the programs themselves. So there's a very long opportunity for Cintas to keep taking share and converting those customers to outsourced programs. So that's the first part of the business, which it's best known for. Now, as Cintas's vans are going around, over time it thought, well, what more can we do for customers while we're there? And it's leveraged its route network and customer relationships to offer other essential services. So, for example, it earns 40% of its revenue from facility services, which is things like restocking kitchen and bathroom supplies, paper towels, soaps and dispensers, rags and towels that might be used by a mechanic or in a kitchen, monthly deep cleans of carpets and upholstery in a hotel or a casino or bathrooms. That's for sanitation compliance reasons, not the same as your daily clean that might be done by a janitor. About 10% of its revenue comes from first aid and safety. What that means is most businesses are required to have first aid kits, cabinets, eye wash stations, hand wash stations, think of a hospital particularly. And Cintas comes in once a fortnight or once a month, inspects the first aid cabinets, makes sure they're compliant, checks the defibrillators, makes sure everything is stocked. And this is something a customer could do themselves, but who's really responsible for it? Is it Zack from finance or someone in operations? What if they go and leave? Then who's responsible for it? Can we really do this at a lower cost than what Cintas is charging us? The answer is no. So it takes this operational burden off the customer. And again, those services are about only half outsourced today. And finally, about 10% of revenue is from fire protection services. And here it's a similar service. They inspect customers' fire equipment. So their extinguishers, their fire alarms, their sprinklers, to make sure they're working fine, they're up to code and compliant. And they have a small business in direct uniform sales, where Cintas sells its proprietary fabrics to customers that still operate uniforms directly. And you might wonder why they would do this. The answer is it establishes a customer relationship, and over time, maybe Cintas can convince them on the value proposition of outsourcing that service. Overall, I think many investors still associate the business with uniform rentals, and they underappreciate the breadth of its services. And as you say, Zack, if you walk any street in North America or into any business in North America, you'd probably see Cintas's logo on their vans, on floor and doormats, on first aid cabinets, tags on fire extinguishers and the like. And today it serves about 1 million of the 16 million businesses in North America. Just a very brief financial overview as well. Its annual revenue is close to $10 billion US. It earns a 22% operating margin, so about 2.2 billion in operating profit. And with a bit of margin expansion and buybacks and so on, it's grown its EPS pretty consistently by a mid to high teens rate. So it has quite a powerful economic engine that we can talk to later. It seems like a really dull business, but its growth, its profitability, and its equity shareholder returns are among the highest in the S&P 500 over the last 20 years, 10 years, 5 years, really any time frame you measure.
That was an awesome summary. Clearly, to go from a business approaching $10 billion in sales, something like 21,000 delivery vans, has humble beginnings. I think it's a really great story of the illustration of how we got from the business's founding story in the 1920s depression to the dominant business it is today. I would love you to just give an introduction to how this business came to be and the evolution of it into what it is now.
Cintas has one of the most interesting founding stories of an S&P 500 company that I've seen. As you say, Zach, it has very humble beginnings. It's a literal rags to riches story. It was actually founded by two traveling circus performers, a husband and wife duo. And in the Great Depression in 1929, they were let go in a weak economy. They were quite enterprising. They were working out how they can make ends meet. And they worked out that all these factories in Ohio where they were based use rags in their day-to-day operations. They're literal rags, like old shirts and stuff that have been repurposed. They use them to wipe down equipment and so on. But once they're really dirty and oily, they can't use them anymore, so they just throw them away. So they went around to all these dumpsters and industrial garbage sites, picked up the dirty rags, took them home, washed them by hand, and sold them back to the factories as new rags. And that was the business. It was called Acme Laundry back then. The next evolution of the business, which is worth mentioning, is when the founder's son, Doc's son, Herschel, became CEO. This was in the 1940s. And under his leadership, Cintas became not just another supplier to these customers selling back the rags, it became a service company. So he realized that customers' need for these rags is ongoing, so maybe we can lease it to them rather than sell them back. And it removes the need for them to invest in the inventory. We can take that burden off their hands. It creates an ongoing relationship with Cintas and ongoing revenue for Cintas. Then it was passed on to the next generation. So Herschel's son, Richard, he became CEO at the age of 25 in the 1960s. He was Cintas's longest running CEO for nearly 30 years, quite instrumental in developing its corporate culture, which is one element of its secret sauce, its success. What he did was he expanded the business into uniform rentals. So the thought was, well, we've got these laundry facilities now. What else can we run through them apart from rags? So he came up with things like doormats, towels and wipes that you might use in a kitchen, and uniforms. And most businesses need a uniform. Any business that's customer facing, any business that has technical needs, as I said, a mechanic or a hospital needs a uniform. So it's quite a broadly applicable service. The company went public in 1983. By then it was known as Cintas. And since then, the real big development for the business has been broadening the range of services it provides, the range of end markets that it serves, the range of customers that it serves, and in geographies as well. It entered Canada in 1995, that first aid and safety business in 1997, some of which was through acquisition, and the fire inspection business in 2003. The acquisition that's worth mentioning is in 2017, it acquired the number 4 uniform rental company called G&K for about $2 billion. Not huge, but it was sizable. It added 20% to its revenue and cemented it as the clear leader in the industry. And I can't understate the family's influence on the business. They were instrumental to creating Cintas into the leader that it is today. The founder's great-grandson is still chairman of the company, executive chairman actually. The family still owns 14% of the company's stock.
Rare to see a situation with which a business that has this type of longevity has retained its shareholder base of family interest to as significant a proportion as it has, I think 15% plus. You did a great job giving the overview of the financial profile of the business, but I'd love to dig a bit deeper into what is the true economic model here? Why is it such a consistent and durable franchise? Presumably switching costs are high. I don't know that there are significant barriers to entry, but perhaps scale being one of them. I'd love to just kind of unpack the economic model that has made them such a strong business.
Well, I might start with how it engages with its customers. So generally, it signs 3 to 5 year contracts for its services. The reason being that it does need to make upfront investments in the uniforms and the supplies to serve a customer. So it needs to realize a return on that investment over a decent period. It incorporates price escalators into those contracts, but they're not a material driver of growth. They tend to be about 0 to 2% a year. And it bills customers simply as the service is delivered. So the uniform rentals is a weekly service. On Monday, the van will come around, it'll pick up the dirty laundry and drop off a fresh set of uniforms. The first aid restocking, I think, tends to be monthly. The facility services can be weekly, fortnightly, monthly, depending on the service. And the fire inspection audits tend to be less regular, maybe once or twice a year. As you said, Zach, Cintas does keep its customers for a very long time. Its customer retention rate is 96%, which means that on average it keeps them for 25 years. The switching costs are reasonably high, especially if you have a contract across the customer's entire operations and you're providing a standard service. For a national customer like Marriott to have to displace a service provider across all your hotels is a big ask. I think Cintas's retention is up there with the best businesses, really, like the best of breed software businesses. Its retention is also much higher than its peers. So, for instance, its largest competitor is a company called Vestis, it used to be called Aramark Uniform Rentals, and it has about an 85-90% retention rate. So that means it has to replenish 10-15% of its customers every year just to stand still.
And then what are the major growth drivers here?
It grows organically at about 6.5% quite consistently, which surprises some that might consider it a cyclical business that's tied to employment growth, but its growth has been quite consistent. About 60% of its growth actually comes from companies that are outsourcing for the first time. So it doesn't have to compete head-to-head with Vestis and UniFirst for those customers. They're entirely greenfield opportunities. And that's very valuable. It means Cintas can get good pricing. It means it can really pitch them on the value proposition of uniform rentals, for instance, rather than competing competitively on price or other elements. It's just a bit tougher. And it's a very durable source of growth because, as I mentioned, half of the market is still insourced. And that's even after Cintas being in business for 100 years. The rest of its growth actually mostly comes from doing more for its existing customers, cross-selling its full range of services. If you go to their website, they have probably 100 or so discrete services across those 3-4 areas that I mentioned earlier. That's a really valuable source of growth. It establishes these long-standing, trusted relationships with its customers, 25 years on average. And with that trust, the customer can give them more over time. Its drivers are actually salespeople in disguise. They're the ones in front of the customer every week or every month. They get to know them by name. They're the ones walking the facilities, taking a look for what else Cintas can do for them. So while we're restocking your kitchen supplies, Zach, I noticed that you have a coffee machine, but there's no mat on the floor. So if there's a spill and someone could slip on the floor, that's a liability for the business. So for $2-3 a week, we can give you a mat as well as the kitchen supplies. It does also win competitively. I don't want to give you the impression that it doesn't, but I think winning business from its competitors is not as important as growing with its customers and growing its customer base.
And what has the business's growth meant for its financial performance, particularly as it relates to its competition?
So really interestingly, when the business IPO'd in 1983, it was about the same size as the number 2 and number 3 players, UniFirst and Aramark. And today, it's 3 times the size of Vestis, the number 2 player, and 4 times the size of UniFirst, the number 3 player. And it's just kept widening that competitive gap over time. So very impressive. It's also much more profitable than its peers. So let me give you some numbers around that. Its return on operating assets, which is its operating profit divided by working capital plus PP&E, is over 50%. So that means it earns 50 cents of annual profit for every dollar of capital it invests in its operations. That's a very good return. But it's 5 times the return that its largest peers earn, let alone the small mom and pops that it also competes with day to day. And that's because it earns a much higher operating profit margin than its peers, about 3 times the margin. And it turns over its assets faster because it has a denser route network. But by itself, having a high return on assets isn't interesting if you're not growing. So Cintas's ability to keep growing at a consistently good rate and then reinvesting capital at a high rate of return to grow further as a really valuable engine of wealth creation. The growth and the high returns go hand in hand to drive that 15% EPS growth. Importantly, probably reflecting its humble beginnings and its frugal culture, ownership, operator mindset. It's always operated with a strong balance sheet, around 1x net debt to EBITDA. And that's important. That allows it to keep investing through downturns. It offers certainty to its customers that know that Cintas will be there for them. And that's really an important differentiator versus its peers. So the number 2 company, Vestas, it's levered about 6x, as was its parent Aramark going back. It's been a real handbrake on that business in terms of its ability to withstand the pandemic and other external shocks. Today, actually, there's more debt than equity in the capital structure of that business. And that's the number 2 player. So it's been a real advantage for Cintas. It's our long-term disciplined capital structure.
I noticed that this business is unique in that its most significant peers are also publicly listed companies. And so you have a great case study in demonstrating the strengths of the business's economic profile and size and scale and returns and profitability. I'd be curious how it compares and to the extent that their competitive advantages continue to deepen.
Yeah, it's a good observation, Zach, although one learning from my investment career is it's very easy to focus on the publicly listed peers of a business. But those top 3 players combined, I think they make up about 60% of the uniform rental market. So 40% of the market is still in the hands of local operators, mostly mum and pops, maybe like Cintas was in the beginning. And not to undermine those competitors, I'm sure they do a very good job for their local clientele. But with those businesses comes the risk of intergenerational transfer. So does the son or daughter of the founder want to inherit the business and continue it? There's an attrition rate in those mum and pop shops. They're not able to serve customers with national sophisticated needs. If you're just a local player, you can't serve Marriott nationally the way that Cintas can. So that's a real advantage versus small players. As is procurement. You buy vastly more materials and chemicals than a small player. So you can be more profitable and you have more resources to invest in your business and your plants and your marketing and so on. But you ask a really good question, which is, it has 2 sizable public competitors. So how is it that they went from being the same size 40 years ago to Cintas making 8 times as much profit as the number 2 player today? It's a really, really wide gap. So I think part of that is also scale. Cintas, because it had a good balance sheet and a long-term mindset, it was early to consolidate the industry in its first sort of 30, 40 years in uniform rentals. And it was able to build local and national density faster than its peers. And that was important. Scale is a massive advantage for Cintas. On the customer-facing side, for any route-based business like Cintas, where the van's going around delivering the service, local density is crucial. So basically, how many customer stops are you making each day that the driver goes around? And also, how many services are you delivering every time you stop at a customer? The higher the answer is to those questions, the more profitable you can be. The vans and the drivers are a fixed cost. So, for example, in the most recent quarter, even though Cintas's revenue grew 9% organically, a really strong result, the number of routes that it serves only grew by 1%. So its revenue per route grew substantially. And not only are there cost benefits to this, but it also allows Cintas to spend more time with its customers and build more loyal relationships. And you can see that in its EBIT margin, the cost benefit. So its operating profit margin has expanded from 14% 10 years ago to 23% today. And that's 3 times what its publicly listed peers own. So it can really serve those really large, complex needs better than its peers. It has more laundry facilities, more distribution facilities, so it can deliver a better service. And then at the back end, I think it's really underappreciated how complex a laundering or a rental operation is. So Cintas actually has over 400 branches across North America, which is where it stores its product, where it launders the product, where it repairs the uniforms. So quite a dense network. And as it grows, it can improve the utilization and efficiency of those plants. Being larger means it can spread its technology, training investments over a larger base of revenue, and it has purchasing scale in its supplies. And finally, the other scale advantage is Cintas has a much larger sales force than its peers, again, 3 times the size. And it's large enough for Cintas to have specialist salespeople in each industry that it serves. Hospitals have very different needs to semifabs or to mechanics. So it can really serve those customers in a way that makes sense to them. So it's a great growth flywheel. If it can grow at a higher rate than its peers, at a better margin than its peers, and reinvest that cash flow to drive further growth, it can continue its success.
Yeah, that's a tough combination to compete with. Would you point to any other advantages beyond scale, or like what is the dominant one?
The second thing which differentiates Cintas from its peers, on the face of it, laundering uniforms and restocking supplies, it sounds very simple. But as I said, operationally, it's very challenging. So using uniforms as an example, the way it works is the uniforms get assigned to a particular employee, usually. So Zack gets 11 uniforms assigned to him. There's the one that he's wearing right now. There's the 5 that are being laundered at the moment that are dirty. And there's the 5 that are waiting in the closet for him to wear for the rest of the week. Most of the uniforms even have the employee's branding on them or the employee's name on them. They're tailored to the needs of the customer, whether it's fabric, materials, sanitation requirements, so on. So Cintas has to make sure that after a week, it picks up all these thousands of uniforms together and they go through its massive laundry facilities, and it has to make sure that they're cleaned with the correct process, that they're inspected properly, and that somehow they get the clean uniform back to the right employee at the right time. It's actually a massive logistical undertaking. And the way Cintas achieves this is it tags every garment with a unique barcode, so it can track those through its facilities, and they're highly automated to minimize the error in that getting back to where it needs to get to. Whereas we've heard that even its larger peers have quite manual operations. So you have people literally sorting these uniforms and reading the tag and trying to work out where it's got to get to. Naturally, that comes with higher error. So Cintas has actually developed all of its garment tracking and all of its routing technology that tells drivers what optimal route they need to do for the day. It's developed that all internally. And then finally, last but not least, I think this is a really important point. I think Cintas isn't special so much for what it does as how it does it. Customers can choose from, I'm sure, dozens of uniform rental companies and dozens of facility service providers in any postcode in the US. But why do they choose Cintas? I think it mostly comes down to people and culture. It's what the company will tell you themselves. And it's so important. They have this book called The Spirit is the Difference. It was written by the founder's grandson, Richard Farmer, who was the CEO for 30 years. If you go and meet with management at the headquarters in Cincinnati, as soon as they shake your hand, they give you a copy of this book. And they say, look, this is really important to us. If you really want to understand our business, read this book. It's quite short. It's about 30 pages. And basically, it outlines why is Cintas in business? Apart from just making money, what role does it play for customers? What does it expect of its employees and how they should treat customers? I'll actually read you a brief passage from the book, which I've got in front of me. This book is about the most important aspect of a Cintas career. It is about something more important than our product, our service, and even more important than sales and profits. It's about what separates great companies like Cintas from mediocre and unsuccessful organizations. It's all about our corporate culture. This is what separates the winners from the losers. Chances are, 2 of every 5 companies on the Fortune 500 list today will not be on the list 10 years from now. What separates those who stay and those who go and don't remain relevant is their cultures. It's really important to the company. We've actually heard that when they interview people, they also give this to every new employee at Cintas. Before the end of the interview process, they give you the book. And they say, go home, take this book home, read through it. If this doesn't resonate with you, this might not be the right place for you to work. So it's very self-selecting.
And so I feel like we've spent a lot of time kind of highlighting the strengths of the business, the competitive advantages that it continues to support. Presumably there are mistakes made along the way. And I'd be curious to hear some of the pitfalls of their strategy and the trials and tribulations of growing from a company that collects rags and resells them to one that's sporting a $10 billion top line and an enterprise value exceeding $75 billion.
It's a great question because even the best of businesses, we can't expect perfection from them. management teams are only human. They'll make mistakes, but it's very telling how they respond to those mistakes and learn from those mistakes. It's certainly been the case with Cintas. So one example is that in the late 1990s, early 2000s, they're always thinking about what more can we provide to customers? What other services can we add to our toolkit? They tried to expand into document management. So I'm not sure if it's a service that you've used before, but we have in our office. They bring out these sort of paper recycling bins. So you put all your paper in there. They pick up the bin on a Friday and they drop off an empty new bin. And then they either store, depending on what you want to do, or they shred the documents securely for you. So the likes of Iron Mountain might deliver that service in the US today. They thought it was a route-based business. It's a regular service. So it's something that could be interesting to our customers. And they made a few small acquisitions to expand in the space. But at the end of the day, they found that firstly, it's a less value-added service than they thought. The guy just literally drops off the bin, picks up a new one. The service takes about 5 seconds to deliver. You don't get time to really chat with the customer, and there's not much you can do to expand the scope of that service. And secondly, I suspect that with declining paper usage in businesses, there were some structural headwinds against that service. It tried something, didn't work, and in the mid-2010s, they sold off that business. I think they actually made a small capital profit on that divestment. But the key is what they didn't do is they didn't go and make some large debt-funded acquisition that might have put the company at risk of long-term damage if it didn't work out. They took a long-term patient approach in building out that business. They were willing to recognize they were wrong, and that's really valuable. And through that whole process, they were incredibly transparent with us, with investors, about how that business was progressing and how it wasn't meeting expectations, and that it's something that they'll have to revisit. So that was a really good experience with the business. And I think the way they communicated transparently and humbly through that period would have given us confidence to stay the course and hold the business, even though the financial picture maybe wasn't what they hoped. Another example is there was an instance about 10 years ago where in the fire inspection business, in the first stages of growing that business, Cintas relied on third-party contractors to deliver the service. And the reason is that every local region has different codes and regulations, every municipality. And given it didn't have experience in the service, it thought it would rely on experienced contractors. But the problem is, if they're not your own employees, if they haven't read this culture book that's so important to you, they might not deliver the same quality of service. And they had a few issues where Cintas inspected buildings, caught on fire, and it turns out the service wasn't delivered to a good standard. They course corrected. They said, look, we'll make the investment needed to build out our own fleet of people, of contractors. We'll train them internally. We'll train them on our culture and how we do business. And it might require some upfront investment. Could be a headwind to our profit margin for a few years, but it's what's needed to deliver better service to customers and to preserve the quality proposition of our brand. I think it's important not to hold businesses to a standard of perfection. And I'm sure that through our ownership period in Cintas, the next 5 years, 10 years, there'll be other challenges it experiences, but how it responds to those challenges is very telling. Another example is in the high inflation of the last few years, you can imagine that all these chemicals that Cintas uses to launder the uniforms or to provide cleaning supplies, all these fabrics that go into the materials and the rags, and there was meaningful inflation in those costs. The same goes for labor, which is a large cost item for Cintas. It's probably over half the cost base is labor. The approach its peers took, UniFirst and Vestas, was customers know that there's inflation, and if we put through price increases, they'll cop it. So they were putting through low double-digit price increases, call it 10%, to try and preserve the margins. Whereas Cintas took a very, very different approach. And the approach was, before we go cap in hand to customers, what can we be doing better? How can we be operating more efficiently internally to try and A, preserve our margin, and B, offset some of this inflation internally before we have to increase our prices? In 2022 and 2023, when its peers were putting through 10% price increases, Cintas was raising prices by 4%, which was less than the rate of inflation, which is incredible. And it actually managed to preserve its margins through that period as well, which is a good sign of its culture and the willingness of its people to just get things done. So there's a few pretty interesting, difficult circumstances that were telling in how the company responded.
And I guess on the back of that, as you kind of look towards the next 3, 5, 10, 20 years of Cintas, what do you see as the risks involved in their business, but also the opportunities that are ahead given the lack of overall penetration into the uniform rental and services businesses domestically and abroad?
The two things that come to mind for me, the culture is the magic of the business. So if there's a management change, which tends to be a catalyst for cultural change that we don't agree with, if the way that management act and communicate changes, that's something we're really sensitive to. Now, I think it's a low risk because, as I mentioned, this culture has been deeply embedded through the business by the founding family who still preside over the business. It's been a very important element of success. The company and management clearly recognize that it takes an active effort to sustain good culture. So I'm quite confident in the stewardship. It is a risk for the business. We've had other instances in our portfolio where there's a change in management that results in the undermining of previously good culture. Secondly is if Cintas loses focus, and the way management approach growth is we've got a really big opportunity in front of us in North America. We only serve 1 million of the 16 million businesses in North America. We don't do anywhere near as much for each of those customers as we could be doing. We've got a very, very broad offering of services. So there's a very, very long runway to keep growing in North America alone. Whereas UniFirst, for instance, they acquired a few businesses in Europe, elsewhere in the world. It's very different. Customers have different needs all over the world. The US is a uniquely homogenous, large single market, whereas in Europe, every country has different regulations, different needs, different ways of doing business. So I'd be very cautious if Cintas started to commit significant capital in expanding overseas, especially since it's told us that there's a very large, long runway of growth in the US. So one example is in the last 10 years or so, it's been building a business in China, which has raised some questions for us. So we'd like to watch and make sure that they haven't yet, but they don't commit a large acquisition or large capital to that business without proving out the proposition. Probably the last one that the company's often asked about, which I don't personally see as a material risk, is cyclicality. There's no problem with cyclicality per se. The problem is if management act in a way during a down cycle that compromises the long-term value of the business. I don't think there's any evidence of that at Cintas. The other risk is that it results in us overvaluing the business if we're valuing the business based on a cyclical high in earnings that may not be sustainable. One thing that Cintas is often associated with is employment growth. Every uniform is tagged to an employee. So if there's high unemployment in the US, investors get concerned that Cintas's growth might slow. There's also an offset to this, that downturns can be a catalyst for companies to outsource more. They're under distress. They want to improve their profitability, and outsourcing is actually a means to that. It's also become a much, much broader business over time. If you looked at Cintas's website 20 years ago and what it can do for customers today, it offers a much broader range of services, serves a much broader range of customers, including more defensive industries like government and healthcare. So I think it'd be much less cyclical than it was in the GFC, where, to be fair, earnings did fall by about a third over that whole period, over a few years. But incredibly, over the last 55 years since it's been listed, its operating profit has only declined in a single instance in the GFC. I think it was an unusual period for a lot of businesses. It was an unusually stressed period. I'm sure Cintas learned from that as well.
With success and scale comes pretty material free cash flow. I think the business does something like $1.5 billion plus of cash flow from operations and minimal CapEx. What is it that they do from a capital allocation perspective to redeploy that cash?
Currently, Cintas pays out about a third of its earnings as a dividend. I think it's about 30%. It's now increased its dividend for 41 consecutive years, and we'd expect that progressive dividend policy to continue. It's also been a steady repurchaser of its shares. Its share count's declined by 1/3 over the last 15 years alone. It's quite impressive. So we expect that to continue if the share count keeps shrinking by a few percent a year. It does spend a modest amount of capital on M&A, generally small bolt-on acquisitions, and then the occasional mid-sized acquisition like G&K in 2017, which was a $2 billion deal. But nothing in the way of large transformative M&A that can really introduce a lot of integration risk and distraction risk. We expect it to continue making small bolt-ons over time, maybe less so than in the past, given it's already achieved a lot of scale in its services. But I'm sure there's small local mom and pops that it can acquire in markets where it's not as strong. As it keeps building out its service lines, I expect it to make acquisitions to build out its offering, build out scale in each of those services, So one example that the management have talked about recently is water cooler services, which again sounds like the most mundane thing. Water is essential. Every business needs some form of delivering water to its employees, whether it's a standalone cooler or one of those desktop taps. It's a very fragmented market. It's a route-based business. They can drop off the full canisters, pick up the empty ones. It's a service proposition. You can have different features of the water, different features of the machine and how it dispenses water. So overall, I think that will drive about mid-teens EPS growth if you add up 6.5% organic growth, a bit of margin expansion, a bit of share count reduction, and then a few percent of growth from M&A.
And I think you had mentioned at the onset that Marriott is obviously an emblematic customer, but I was surprised that a company like Intel would employ their services, just given how sensitive their processes are. I'd love to learn a little bit more about the nature of that relationship.
Interestingly, Cintas don't often talk about individual customers. And one reason is they serve 1 million customers. There's just a lot of them. And no single customer is more than 1% of revenue. Even what it does for Intel, which I'm sure is a large customer, is a very small proportion of the overall offering. What it does for Intel is, as I mentioned, Intel has these semi-fabs that have to be unrealistically clean. Even a speck of dust can compromise the quality of a semi-wafer. So its staff in those fabs are dressed in these astronaut suits that are hermetically sealed and don't have any dust or lint on them. Cintas has to provide uniforms, which I presume are through a specialized laundering process, probably even a specialized route and van that's hermetically sealed, to give those uniforms to Intel's fabs. It's probably a service that very few other companies could deliver to the standard that Intel requires. So I'm not surprised that in Cintas that's serving that contract, not its other publicly listed peers.
And to wrap things up, our customary question is lessons learned, both from your evaluation studies of Cintas as a business that can be applied towards other investments, and conversely, operators and business management and public companies who can borrow from the lessons learned from Cintas and apply them to their businesses.
It's been a real case study for me on the importance of corporate culture as a source of competitive advantage. I think as investors, it's very easy to get seduced by the numbers when you're assessing a business. But that tells us nothing about how the business achieved that success to begin with and whether the success can persist. In our experience, it's really culture that separates the best businesses, those that can continue growing share and being more relevant to customers, from the rest, from those that fade and don't look as relevant in 10 years' time. I know culture, it sounds a bit airy-fairy, it's very intangible, can easily be overlooked. You can't get the answer from your Bloomberg terminal the way that you can for the financial metrics. It's a quality that you have to appreciate over time as you better understand how the business operates, how its people are incentivized, the quality of its management team. A bit like making a friend. Maybe the first few times you meet them, you can see that you click, and then over time, the more you get to know them, you start to appreciate their qualities. Getting to know a business and its culture is a bit the same. So this has been a really valuable experience for us. Another learning is that on the face of it, Cintas might sound very mundane. It delivers a seemingly boring but essential service. It doesn't really capture the attention of investors the way that a high-flying tech company might. But companies that deliver essential services to other businesses can make really great investments. Business customers, they tend to be loyal. They stick around for a long time unless you mess up something with your service. You can sell business customers on a measurable value proposition. It's a really powerful pitch that if you join our service, we can do it 2 to 3 times cheaper than you can yourselves. On the other hand, businesses that face consumers, they tend to be the ones that capture the media's attention. But consumers like trying new things. They're notoriously fickle. They'll have different preferences. So we have a preference for these B2B companies, which fly under the radar.
Well, there's a great Jeff Bezos anecdote about investing in the things that you know are not going to change, which when it comes to the necessity of uniforms and the strength of a route-based business like this one seems quite likely, of course, to some extent reflected in the valuation of a business like this. But to your point, the durability and the strength of their continued growth and earnings certainly come through. We appreciate you spending this time with us, Delian. This is a fascinating story.
Thanks for having me, Zach.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JOINCOLOSSUS.com.
A quick note before you go. If you are a company hiring or a candidate looking for your next opportunity, make sure to check out joincolossus.com/recruiting. We launched our recruiting efforts at the end of last year. We started working with firms that were interested in tapping into our audience. And after seeing some early success, we want to open this up to additional firms and to candidates who are proactively looking for their next opportunity. So we are mostly revolving around the investment world and the tech industry. But again, make sure to check out joincolossus.com/recruiting for more information.